You are listening to Chapter 2, Lesson 5 of Form 5 Economics. Cameroon General Education. Narrated by Wacheseh Academy. Budget and types of budget. 2. Definition. 3. Types of budget. The state can either budget for a deficit, a surplus, or a balanced budget depending on her objectives. A balanced budget, G equals T. This is when government expenditures, G, are exactly equal to government revenue, T. For example, planned government expenditure may be 20 million, and planned government revenue 20 million. It can be for the following reasons: to stabilize the economy, that is, avoid price fluctuation; to avoid borrowing and be self-reliant; to ensure a steady rate of economic growth. B. A budget deficit, G, T. This is when government expenditures are greater than government revenue. For example, G equals 10 million and TX equals 8 million, making a deficit of 2M, the government will have to borrow 2M to finance its expenditures. The reasons include: to solve deflation, as money will be injected into the economy, stimulating demand, and a rise in price; to increase aggregate demand. When the living standard is low, the Gov-T may budget for a deficit so as to inject money into the economy and increase the demand for goods and services; to increase employment, since government spending will raise the income level and aggregate demand. Firms will need more laborers to increase supply; to stimulate a recovery from a slump. When an economy is depressed, it can effectively be revived by increasing AD, through which the rate of investment and employment will rise, and a greater rate of economic growth. C. Budget surplus, G, T. This is when government expenditures are less than government revenue, generating a surplus. It can be for the following reasons: to remedy inflation. When direct taxes are increased and government spending reduced, people have less money to demand goods, hence a fall in price. To have funds to repay debt incurred during deficit. A budget surplus generates money to pay debts generated by a deficit. To avoid borrowing. Borrowing is mostly attached to a very high rate of interest, so a country may budget a surplus to prevent such situations. Taxation. 1. Definition of taxation. A tax. It is a compulsory payment imposed by the government on individuals, institutions, and corporate bodies, at regular intervals for which there are no direct benefits. It is levied on the tax base. 1. A tax base. This is the object which is taxed, either income and wealth, direct taxes, or goods and services, indirect taxes. It determines the nature of the tax. 2. A tax rate. This is the amount deducted as tax express, as a percentage of the tax base. This tax rate can be the average rate of tax, or the marginal rate of tax.